We are also watching the bond market, and actually, for the first time in a week, we saw some interest in U.S. Treasuries, in part because some new inflation data seems to be cementing some views on interest rates south of the border. Konstantin Boehmer is joining us now, head of fixed income and portfolio manager. He's a portfolio manager at Mackenzie Investments. Nice to see you.
Great to see you again.
I'm glad you're here. As we sort of go back and forth, we've got multiple inflation readings to look at in Canada and the United States. Let's just start with the U.S. So you've got a number of indications this week that inflation worries perhaps were a little overblown, and so people are now taking a fresh look at bond yields where they are as a possible entry point.
Yeah, I think so. We've had multiple times now that we've waited for inflation to come up, and we can see that pretty clearly in inflation expectations. So every month when inflation prints come out, you have a bunch of strategists and economists expect or put a survey out, what do they expect of that inflation print? And that has been undershot now 5 times in a row. So that is, somebody is, or the people in the streets are expecting inflation to pick up, but it has disappointed, or it has come lower multiple times. So that is an indication that that inflation surge that a lot of people were expecting due to the tariffs has not yet appeared. And if it hasn't appeared up until now, the question is, will it appear in the future? And the doubts are showing that that is not really happening that quickly.
So how might that influence the amount of money that would go into bonds over the next couple of months? And I only ask that because you've got a lot of strategists on the equity side who say, you know, don't fight the tape. There's going to be some strong interest in stocks that are at all-time highs. But if there's more cemented views that inflation is not as big an issue in the U.S. as was previously thought, I would imagine that would possibly bring some people off the sidelines into the bond market.
Yeah, I mean, the bond market should like those things because it is also a critical aspect for the Federal Reserve, for them looking at inflation, and that is how they have communicated that also to market participants. They are concerned about inflation, and they have been waiting also for inflation to pick up. Given that it has not occurred as they expected, their tendency or their likelihood of starting to cut rates is a little bit higher. So that it shifts more from paying attention to the inflation picture to looking at what is happening on the growth side, what is happening in the labor market. It's not looking terrible there either, but it is probably putting more emphasis on economic data. If there's any weakness coming on that side, the likelihood that the Fed will react is fairly high.
So if you had to sort of summarize what overall interest in bonds, government bonds in the U.S. looks like right now, because the other factor out there, you know, people talk about the fiscal stuff. What is the appetite, would you say?
I mean, it's not like overly exciting for investors, but it is, if you look at overall yields, we're looking at 5% in the 30-year space. So that is generally an attractive proposition for lots of people. And if you also...
In early April, I'm sure that would have been very attractive to a lot of people too.
And especially long-term buyers of debt, they're oftentimes coming in at those big pivotal levels. So 5% 30-year is one of them. And if you look at inflation-linked bonds, which is stripping out the inflation component, and you're just saying, whatever is happening on the inflation side, you get that compensation and you get an additional yield for that. That is looking fairly attractive, of over 2.5%. So that is your real net worth in 30-year U.S. inflation-linked bonds is growing by over 2.5% per year. That is a fairly attractive proposition.
And by comparison, in Canada, where it seems like we're navigating these inflation issues lingering along here, same question, like what's the appetite for Canadian government bonds right now?
I would say broadly similar. My own appetite for Canadian bonds is a little bit less than it is for US, so I have a fairly strong preference for liking US bonds more than Canadians. It is because the yield differential is fairly significant. So US bonds are offering a lot more than Canadian bonds, and that is probably not as justified as the market is currently looking at it.
Can you just explain why we see that differential as well?
Yeah, so I mean, we have, number one, we have central banks which have different policy rates. So the Canadian policy rate is significantly below the US. But there's also, especially at the longer end of the curve, there has been a huge divergence between Canada and US, and that is based on the long-term, let's say, growth and inflation outlook for those two countries. But if I look at data going back probably 60 years or so when we did our analysis, that is looking at the GDP difference, the 30-year average GDP difference between Canada and US. And the 30-year GDP, nominal GDP, is roughly equivalent to where 30-year bonds should trade. And Canada and US are behaving very, very similarly as two countries over the last 60 years. So that differential of 30-year nominal growth has been tiny over the past decades, and the market is currently expecting that that difference is starting to show up, so that the US nominal growth forward-looking will be substantially larger than the Canadian nominal growth, so that is real growth plus inflation, and we don't see that happening. We think that those two countries are very closely aligned in terms of nominal growth, and therefore that 100 basis points spread differential between Canadian yields lower and US yields higher is not really justified.
I have a final question. My question is quick. It invites a potentially long answer, but we just finished a segment with an equity strategist who feels we're in a longer-term bullish environment for U.S. stocks. For years we would talk about things like a 60-40 split for an investor's portfolio. What do you think sort of the longer-term story of where fixed income fits into a portfolio looks like for Canadian investors?
Yeah, I think given how much yields have risen in the past few years, they do have a place in a portfolio, because you do have the possibility, if there is a major economic event, and that is obviously a big if, and policymakers have been pretty good at limiting those negative events, but if there is a negative economic event, the bond market should react positively, because that will bring the central banks of the world again to the table, starting to cut rates. Usually when you have an economic contraction, you have both growth coming down and inflation coming down, plus central bank cutting rates. That would be highly beneficial for bonds. And given that yields are now at elevated levels, you should also experience some price gains above and beyond just the coupons.
All right.